Welcome to the show. This is a money show again with a special guest. Today we have a Dylan Marma. And we do those real estate shows from time to time for you guys to build up the skills in real estate space. So this show is a special for you because he's a multifamily investor with Rand Partners LLC, which has 75 million assets under management. How many units is that, Dylan?
Well, actually, at the end of this week, we're closing on a project right now, so it'll be a little bit over 90 million, and that's going to be about 1,500 units as a team. Started back in 2013, so it's been a good run.
Wow, that's crazy, man! 1,500 units. I mean, I hope audience wants to be on the same levels. I want to be on the same level as you are, so that's why I'm doing it. From a selfish point a little bit, and at the same time, guys, you're watching, and. Like real estate is a space, you already know it's a good space to be in because, a lot of people just lack the information, where to start and what to do, and what resources need to have. So, by having Dylan today on a show, which I really appreciate, I think will give you more insights into this space and what it takes to start building 1,500 units. I mean, man, come on. So can you just tell the story, how it all started for you and how did you came across the real estate space in the first place?
Yeah, absolutely. So I actually have been a part of this team. I joined about a month back, but I started in real estate about 3 years ago. So the company Rand Partners was founded. Many of you may have heard of the two of our partners. We have a group of 4 of us that run the business, but it was founded by Jake and Gino back in 2013, starting with a small 25 unit and very humble beginnings, growing a lot of this stuff into a vertically integrated organization from day one. Jake led the asset and property management stuff. And then I got my own start. Actually, I originally grew up in upstate New York, flew out to California to go work for a real estate investing and education company out there, where I was surrounded by people from all different realms of the real estate world, whether it's commercial, whether it's multifamily, industrial, a lot of single family, a lot of residential. I saw what the fix and flip process looked like, I saw what the wholesale process looked like. So I really got a lot of exposure in a very short time period, about 3 years working for this group. And it really led me to understanding the fundamentals of how real estate worked. I started off just like most people do with a single family house, cash flowing a few $100s per month. Then I bought a duplex. And then it took me not too long to realize that I needed to get into a better vehicle, and I knew that there was better ways of going out there and creating wealth with real estate. And I saw the benefits of multifamily. I saw the economies of scale that are available to investors. I saw that, with the efforts that go into one, 50 or 100 unit deal in multifamily, it would take a lot more effort to close on 50 or 100 doors of single family. So I saw, just a lot of advantages to multifamily, and then I really became enamored by the process of syndication and how that works and how you can truly create an investment that most people don't have access to and create a true win-win, both as a company growing an organization, scaling using syndication, and also offering a great product to investors where they can invest and get a true passive income through such a good asset.
Yeah, 100%, of course. Real estate, so where did it started for you? I mean, the question is like, did you pick up a book or something? Because most of the guys, they read Rich Dad Poor Dad and they come across, from that side, or did you go to the event? Like, how did you find out about the real estate opportunity in the first place?
Yeah. Good question, and I don't have a super unique answer. Probably the same way a lot of people get into real estate, right? I was a big reader. I've been a big reader since I was probably about 18. I started picking up a lot of books on different things about personal growth and entrepreneurship. I dabbled in different forms of sales and entrepreneurship. And of course, a lot of what I was reading was the books that led me back to real estate. I think Rich Dad Poor Dad, of course, had a big impact on me. And I remember not only did I read it, but I probably gifted it to about 10 people after reading it because I realized that everyone needs to get a hold of this, right? So I read, a lot of different books that educate me on different aspects of it. And then I'm really the type to just go all in once I make the decision to go after something. So I made a commitment to go out to California. That was not because I saw a thriving market in California, but more so because I wanted to live out there and create this kind of lifestyle by design that I had envisioned. So I moved out there and interviewed with several companies in terms of real estate, put my resume out anywhere I could, and then I found one that I was very happy to be a part of. And I was surrounded by a lot of great mentors. And then into multifamily, it was a similar type of a process, right? At that point, I had established a pretty big network. So I had a lot of really successful high net worth mentors, and I consulted with them to make sure that as I was entering this path, that there was the opportunity that I had envisioned in place. So that was really just fortunate to have the right people in my life.
Yeah, okay. Because I have a follow-on question here, about, because, the team, everything is important. I mean, in the real estate space, I want to talk about it a little bit later, but, when it comes to the real estate, how do you determine your investment criteria? What do you base on it?
Yeah, so for what we do specifically, right, we're based out of Knoxville, Tennessee. So we're in the heart of the Southeast. We target deals within a 4-hour drive radius. So there's a lot of different markets out here. We're currently invested primarily in Knoxville and also Louisville, Kentucky. But there's a ton of other cities out here. There's Lexington, there's Nashville, there's Greenville, there's the Carolinas, Raleigh, there's Huntsville, there's Atlanta, Birmingham. I mean, you name it, there's a lot of cities, and there's a lot of growth taking place currently here in the Southeast. There's a lot of tax advantages here. There's good weather here. So people from up north and around the Rust Belt are starting to move down south and take advantage of that for themselves. So we see a lot of population migration moving into the area. Now, what we really look for is we target, really our bread and butter is workforce housing. So there's a lot of blue collar, industrial, and some healthcare, right? So we really are looking for not only good markets, but also sub-markets that have a lot of strong employers with a diverse base of various employers in different sectors. So we can feel really confident that we're going to be able to attract our target residents for each property. And then we're going in and finding stuff that receives cash flow from day one, but we're buying existing assets, usually older builds, say anything built before the 2000s. And then we are usually going in there and finding ways to add value through increasing the income, whether it's increasing up to market rents or finding other income streams or decreasing the expenses, just running the property overall more efficient. That way the investors can receive strong cash flow year over year. Usually we'll target anywhere between 5 to 7 or 6 to 8 year holds. So it's a relatively longer holds. And then, we're also going to be able to realize a lot of appreciation on the back end, because commercial real estate is all focused on the income approach, right? That's how you're going to, when you buy a single family house, it's really based off of the comps in the neighborhood, and how much your neighbor's house sold for is what's going to determine how much your house is selling for. In multifamily, it's valued very differently. It's valued completely on the income approach. So it's really the net operating income that determines the purchase price. So if you go in with the lower net operating income, then you're going to go out and sell it with, usually you're going to realize a higher purchase price upon the sale.
Yeah. Okay, got it. Okay. Man, that's just so much valuable information. Probably just took 2 minutes to answer, but because you see, Dylan is the expert on the space. So guys, please press like and share if you enjoy the video so far, because we're bringing you the best people in the industries, and Dylan is one of them. So please go and check it out, him as well. Find the links down below. If somebody's here who's watching right now is interested, maybe he wants to start doing syndications himself or start to raise capital, where a person can start doing that? What did it took for you? Because you said you've been part of the high net worth people, but what was the first steps for you to do to be in this business?
Yeah. So the unique thing about this business is there's no one cookie cutter blueprint to getting into the space, right? My first deal was 21 units, my first multifamily deal. My partner started off with, 25 units, started off with a small deal. On that first deal, I put a lot of my skin in the game. It was not a syndication. And I recommend a lot of people start there if you have some extra capital to go out there and find a deal that you can purchase yourself, right? We actually have this, we have 4 different businesses running under one roof here. We have a management business, an investment business, we have a loan brokerage, and then we also have the education component. So in the education component, we're kind of teaching people stuff on how to get into their first deal. And that's really where it starts, I think, is just starting with whatever capital you do have, to put some kind of skin in the game and get some kind of an acquisition, maybe with some partners on board if you don't have enough to buy a whole deal yourself. and then starting to learn the process and learn what goes into the takeover process and the asset management process, and if you're self-managing, developing systems for that. So I think that's how to get into multifamily first. And then in terms of syndication, there's a couple different ways, right? The two biggest ways to add value is, of course, finding the deal or raising the capital. I think finding the deal is probably the more difficult of the two for many, because although there are a lot of deals out there, and it's a lot of these deals are listed, there's no MLS for commercial real estate, but a lot of them are listed publicly from the various brokerages. So if you're on the brokerage email list, you'll be able to receive some of the on-market listings, but a lot of the best deals that investors are not seeing are the off-market deals, and usually you have to have some kind of a resume to be able to build a relationship with an investor and establish with the broker to establish that rapport to get the off-market deals. So I think finding deals can be a really valuable skill set, but just know usually you're gonna have to look at 100 deals to find the one, and when you're starting off, it can be very difficult for you to find a deal and go kind of bird dog it to bring it to a larger group like us to receive some kind of partnership, right? But that is one way to do it, and I think it's not a bad route to go. Just know there's a lot of work that goes into it. I always like to just set realistic standards. And then the other way to get into syndication and start to build up your credibility, if you're not going to handle the whole thing start to finish, which I usually don't recommend doing at first. I think it is good to partner with an experienced group and really start to build your own knowledge base. But the other way, like you said, is to raise capital. Capital can be great because all money is treated the same essentially, right? No matter where the money is coming from, you're going to get the same returns out of the deal. And I think there's a lot of sponsors out there, and we currently haven't partnered with anyone to raise capital for us. We pretty much we're vertically integrated, so we try to do a lot of this in-house. But there are a lot of sponsors out there, operators that are in need of some extra capital, to where they may partner with you if you're able to raise a certain amount of capital for them to help them fund and grow their deal. So if you have, if you're in a network of, say doctors or attorneys, or you're in the technology field, right? If you're in or an entrepreneur, right? If you're in some of these different networks that have a lot of high net worth individuals around you, then you might be in a good position to start to educate yourself, maybe start to invest passively yourself into syndications, and then begin to kind of plant seeds with the folks that are around you, and share the exciting news about what you're doing, and then eventually being able to build your own brand and raise investor capital, partnering with someone that has experience. Okay.
So can I just, track it back and see if I heard that right? So you're saying if a person doesn't have an access to a high net worth individuals, or the person doesn't have a business, he should start investing on his own money into the deals. Let's say it's going to be 12 or, what's the number? It's 4 units plus counts as a commercial property.
Technically, yeah, anything over 4 units. It's kind of tough to evaluate the smaller units in my head. I think it makes sense to probably start somewhere around 20 plus units. I think that's you really start to realize the economies of scale at that level, and it becomes a little bit easier to underwrite the deal on the front end.
Yeah. And it costs less. I mean, everybody's getting paid enough, because you have to have enough doors to get so everybody would get paid, because the management won't rip you off and stuff like that. So I mean, making sense.
Correct.
So coming back to that, okay, and if you have a net worth individuals, and you have maybe the business that you do, full time, so you're gonna recommend for that person to go into the syndication straight away, or to invest his own capital still and acquire his own deals?
Yeah, I think it makes sense to acquire your own deals first, or if you're going to invest and you plan on being an operator in the syndication space, it's it just takes a lot of dedication to your learning and finding someone that has experience that offers you the ability to partner.
Okay. And what if somebody's watching now thinking, okay, listen, I'm not high net worth individual. I don't know nobody, no doctors, nobody, everybody's around me broke. I'm broke. I don't have any money, right? And this situation. So how do I start? What's the first step? I want to be in real estate. I want to do syndications, but I don't have a business. I don't have the money. Is it possible for a person, just to dive in without the experience. Maybe he's, read something or heard something. He's following maybe some, the right people, let's say, and, just based on that, would you recommend for people to go in or build some sort of
it depends on who it is. I think anything with the right amount of discipline and determination is possible, right? I think it is possible to set, realistic expectations. I don't think it's easy, right? I don't think it's a shiny object that, just because you've heard about it and it sounds like it's profitable, I don't think it's something you should just jump into or dabble with. I think it's something that if you've really studied up on it and you feel like it's something that you want to dedicate decades of your life to, then you should probably, find a way of going about doing it. Maybe in that case, it's a longer term view because it's a long-term game, but maybe you go work for someone that is doing it, right? Maybe you find, take some of your skill sets and go to work, and either go to work for free if you have to, right? Because maybe you don't have the skill sets to get hired right away, but maybe you offer your time for free and investing into relationships. Find some way of seeking to serve. I always say you can either seek to serve or pay to play when it comes to finding mentors and finding ways to get educated. So maybe there's some way that you can add value to someone else out there. But even with that, it's difficult, right? Because if you're not familiar with underwriting deals and things like that, they're going to have to invest a lot back into you. So I think that's really the challenge that starting off everyone has to go through is that first off, they don't know what market to look, and they don't know how to get into their first deal. They don't know what they want long term. So I think it's getting crystal clear on what you want, right? And truth be told, if you look at syndication, it's a real business, and it's very active business, right? This is not a business to just sit back and create passive income and just travel and just not have to work anymore, right? That this is not the way to do it, right?
This is not the Instagram, guys.
No, exactly. This is definitely all hands on deck, very active. If you want true passive income, you're probably better off, finding a way to make enough capital so you can invest it into syndications with sponsors, or finding ways to get into your own deal of some sort and just holding it long term for cash flow. So that's why I always say get clear on what you want first, because not everyone wants what this business entails, and I always try not to sugarcoat it and make it sound easy. It's definitely a lot of work, and there's a lot of moving parts that go into it. But that being said, I always say that if you're doing the right things and you're working hard, then doors will open. So maybe doing the right things when you're starting off is just reading all the books, going to every networking event that you can get in front of, listening to podcasts like yours, right? Listening to guys that are doing it, and just networking, and eventually something may click where you can start to find a way to make it happen.
Yeah, exactly. Love it, man. So I'm not gonna start talking about that, but let's jump in a something a little bit deeper, about how to find the deals and all that, because like a lot of people that are going to be listening, they're not from States. A lot of them are from States. And, as you guys who are watching here in Europe, maybe, we don't have a lot of multifamily deals around. There is, because I spoke with some people, especially here in the Ireland market, and they known as an investors in a real estate space. But, it's a different subject I wanted to talk about, but it's basically they're saying there's not multifamily deals around in Ireland. I'm like, man, listen, I'm not an investor, and I know like those deals are available, and I was just pointed at and like, look, that offering memorandum, like, so it's available, but you have to look. Like, we don't have thousands of units, in here. Yeah. Still, it's possible to do what Dylan is doing, but I want to talk specifically to the U.S. market. How do you choose? Maybe how do you pick your market for investing, and should somebody invest out of state?
Yeah, well, that's a great question. And I think, in Ireland and most of the rest of the world, you don't have, it is actually something that is pretty unique to the United States in terms of the large complexes. And I think the cap rates in the United States are higher as well. I think it's a lower cap rate environment in most of Europe, from my understanding. So I think when you look at the States, the benefits are that, one of the best things that multifamily has going for it, I'd say, is the debt that's available. Multifamily, out of any other real estate class, has the absolute best terms in terms of the financing that's available, right? And usually you're going to finance anywhere between 60% to 80% of the deal through a bank, and we have, federally backed loans with Fannie and Freddie. You have a lot of private bank loans. There's
How much do you recommend for people how much to leverage on the debt? I mean, is it
It just depends on the deal. There's no magic way of doing it. Depends on the deal, how much risk you're willing to take on, and things like that.
Don't over leverage, or what are you saying?
You don't want to over leverage, but you also don't want to under leverage and have no returns, right?
So what's the risky number? Let's say, like not 90%. I mean, if the deal it depends on the deal, how much bank is going to give you, right?
Yeah, here's the thing. Yeah, it depends on the deal, like you said. So there's usually, if you're going through the most secure type of financing, which is your non-recourse debt that's available through Fannie and Freddie, usually you're going to be DCR constrained at some extent. So what that typically means,
it has to be 1.25.
Yeah, so you're going to have your debt coverage ratio, meaning that your net operating income has to be, at least 125% of whatever your debt payments are to buy the deal. So the banks know this, they study this stuff. In some markets, it's 135 even. And they know what level of risk they're willing to take on. So they're almost there like a safety net for you if you're using traditional financing to make sure that you're not over leveraging yourself. So I'd say most deals, people become debt constrained at a certain point. But usually in most deals, we're going in confident enough to maximize our leverage until the point where we're debt constrained. Because usually we're doing value add deals that we plan on increasing the net operating income in the first place. But if you go out there and use, bridge financing, which is kind of like alternative financing, which is recourse, and it can be riskier, higher interest rate, then that's where you really want to be thoughtful about what your debt coverage is, because they might accept a 1.0 debt coverage ratio or even less in some cases. So in those cases, you want to be more thoughtful about that. And that's all. I can't break that down here. It's really a deal by deal scenario.
Yeah. So, okay. So people should invest into, let's say somebody's starting right now in California, and, California maybe is not the right market for them. They can't find the deals, it's too expensive, they don't have the capital for it, but it's possible to buy a deal somewhere in Georgia. So should someone consider doing that in the beginning when they started?
Yeah, I think it makes a lot of sense. Is it easy? No, right? I think calling brokers from California, most deals are done through brokers, right? There's not as much of the direct to owner deals that get done. They do happen from time to time, especially as you grow in the space, but it's mostly through brokers. That's really your key to the castle in terms of finding the right deal. And if you're the California buyer with no experience, or you're in Europe with no experience, right, and you're calling to different brokers in the States, you really have to have quite the message behind you to convince them that you're serious, that you're ready to close in the deal, right? So number one, if you're going to attempt to do that, I think you want to fly out very often to your target market, walk a lot of deals, meet a lot of brokers on a face-to-face basis, and start to develop really strong relationships. Because I think that, it just knowing that, being the guy behind your computer, making some calls is going to be difficult for you to truly win the deal. So I think flying out, making trips to different things makes a lot of sense. Or you partner with someone that's boots on the ground. It's probably even a better method to go at first, right? If you have capital, or you're raising capital, whatever you're bringing to the table, you may want to find someone that lives in your target market that's also interested in the space, or maybe has done deals before, and develop some kind of a partnership where you play your role, but they play their role, and they're able to be the boots on the ground that represents you. Even getting a loan when you live across the country, or you live out of the country, is difficult because a lot of times they like to have a boots on the ground in the local area to feel comfortable with the loan.
Yeah. And you spoke before. I remember last time we spoke briefly for a few minutes. You mentioned it's, some people who are investing out of state, out of country. People from different continents investing into deals into states. So that's available also, right?
It is. Yeah, absolutely. There's plenty of out of country, investors that do invest into the States. And we're going to be open for that for syndications as people want to invest passively. It's a unique asset class that, like you said, is very hard to find in any other place in the world right now. Of course, big institutions are doing deals in other countries as well. So there's real estate opportunities anywhere you look. But out of state or out of country investors are definitely, they definitely still play in the same market pretty often.
Yeah, yeah. Because again, there's not many of these properties here in Europe. So people with money, like like high net worth people, they are looking for place to put their money because the bank is not the place anymore. So those people are looking for places, like, and real estate is
Yep.
just, you like you provide. I checked on your page before I did a due diligence. So you provide a good return, for people's money. So people
Yeah,
again
we're
just want to
typically
protect.
targeting.
They want to
Yeah,
protect
we're
their capital. It's,
typically targeting 8% cash flows, year over year, and that's just directly a lot of times upon purchase or takeover, and then we're usually going to raise that anywhere between 8 to 10% year over year, and then with the back end, including the appreciation on the sale, it's usually an average of north of 15% on that for the investors. So I know it is difficult, especially for the cash flows, to find that in real estate in many other countries at this point.
Yeah, yeah, exactly. So, would you give a one tip or maybe your best advice when it comes to underwriting deals for people who are starting into this space?
Well, practice, practice, practice. I think that's really the key. I think when you're looking at underwriting deals, there's a lot of a lot of work that goes into it. If you have a mentor of some sort that can kind of double check you and look over your deal and tell you where you missed, I think that's probably the most helpful thing it was for me when I was learning. But it really comes down to it sometimes. I've led meetups and been around, do some consulting. And I've been around a lot of people starting off in the business. And I think that's sometimes the elephant in the room where they want to, kind of avoid underwriting because it's this big, scary thing. And it's really not that hard. It's not that complex. It just takes discipline and practice and having the right tool in place. And then, as you look at enough deals, you'll start to develop confidence there. And your confidence in your underwriting is going to equate to confidence on the phone with brokers. It's going to equate to confidence in your offers, and it's going to help you get into that first deal.
Okay. So, how long does it take for you? Let's say for a person, how long should it take to underwrite a deal? Because everybody's saying, some people are saying, oh, it's going to take 5 minutes, and somebody's saying it's going to take 3 days. Well, what's the number? How long did it take for you to?
That's a good question. I don't think you should ever put in an offer if you've spent less than 30 minutes on the deal. I think you should definitely be able to do quick underwritings as well, though, right? We call it the back of the napkin tab on our underwriting tool that we pretty much do a quick run through. But before I even look at the numbers, I'm looking at the deal itself, the physical location, the proximity to employers, the median income in the area, the crime rate. And then if that all checks out, then I'm going to run the quick and dirty numbers and basically get a feel for if I'm in the ballpark of what the broker's asking for. And then I'll usually call them and make sure I am in the ballpark. And if it's worth looking deeper into, then I'll sharpen my pencil and go into more of a thorough underwriting where I'm looking at it over a 5-year timeline. And that process can take an hour or so, or sometimes more. It really depends on the deal itself and how thorough we're going to go before our initial offer. And usually it's like a 5-round process of your market analysis, then it's your first round of financial analysis, then a next underwriting, then your best and final underwriting, and so on.
Okay. And do you have a team to back it? I mean, does other people from your team, they look at the deals also? At the same deals, if you find somebody and you think it might be a potential investment.
Yeah, we have, there's 4 of us that are partners. We don't have, currently, we don't have in-house analysts or anything like that. It is something that we were definitely looking into in the near future as we continue to grow. But as time being, there's 4 of us, so we all bounce ideas off each other and give it a second look to make sure we all feel confident about it.
Yeah. So is it the most important thing, basically, in the first place, it has to fit the criteria for the deal, right?
Yep, exactly.
So how strong does the criteria have to be for somebody? Can they like go off a little bit? If I'm good, the first deal have to be, as you said, 20 plus units, but maybe I don't have the capital, for 20. So maybe I will do just a little bit short, like 15.
Yeah, I think that's fine. Yeah, dude. Yeah, and I think it's never. You can get caught up in so many places with analysis paralysis and trying to find the perfect deal in the perfect market at the perfect time. And in reality, your first deal, I don't know if I've ever seen a perfect first deal, right? Because you're still learning, right? So I think going into it, having some kind of flexibility is important.
Yeah, but don't if I determine to invest into B type of properties, B type of maybe C type of locations. I don't want to change that to D type of properties in D type of locations. You know what I'm saying? Like, can people like, oh, I don't have that, start making excuses and start like not following basically the property type that you want to invest in?
Yeah, if you start to veer off and you don't want to get stuck in just the mindset of getting a deal done for the sake of getting a deal done.
Yeah.
And that's definitely where you can get hurt, is when you start to justify and start to lower your standards.
Okay, got it. So, okay, we spoke about the financing. You guys can rewind back to look at it. Like, so you say don't over leverage, right? About the financing. And what do you think, like, when it comes to that? Like, because people are scared about the banks, they think bank is the enemy. Is how do you look at the banks? Is bank the enemy? Because you said it might help you to underwrite the deals and see if it's a potential. If you actually can acquire it, and is it even hard for a person who's starting in the first place, like to get a loan from a bank? I mean, what they're going to be looking for from a person?
Yeah, so it shouldn't be that difficult. I think the banks are, our friends, and they can be the biggest partner of ours, right? That's why we started a in-house loan brokerage, because we know that there's a lot of people that are still seeking how to find the best areas to get their financing. So we've started it's a broker format where pretty much we have all of our connections that we work with in our own deals. We offer that to others. But as far as financing, what you need, typically you need a net worth equal to the entirety of the loan balance. So if you have a $10 million loan, you need a $10 million net worth behind that. And that can be two people with $5 million net worths as well. It can be a collective net worth. And then usually you need at least 6 to 12 months of liquidity from the group. So funds that are either completely liquid or very easily accessible, to make sure that if there is a downturn, that you're able to fund the deficit. That's typically what the banks look for. It's not as much in the residential space. They're all looking at your debt to income ratio on a personal level. They're looking at your tax, your credit score, and things like that. This is less of that. It's more about how much your net worth and liquidity are.
Okay, got it.
And of course, how does the deal make sense? Like I said, they can act as a safety net for you, and they're vetting the deal just as much as you are, because they want to make sure it's a good spot to place their capital.
Exactly. So as you're saying again, the bank is not the enemy, because the people have the opposite reaction. I mean, the bank, I'm going to go to the bank and this is like the enemy. I have to prove him that this is like, guys, the bank is trying to be on your side, because they don't want to lose their investment that they doing, by putting, into this deal. So can you just talk about the best and the worst investments that you did, and what did you learn from it?
Yeah, so in terms of the best investment I've done, let's think about that. I mean, I think the best investment you can make is an investment into yourself. I think that's for me. I spent a lot of time reading. I've definitely had a fair amount of mentors in my life, people that I've consulted with to help me, on my own journey. And I think, it starts there really, is investing into yourself. As far as best real estate deal, I am very happy about the first syndication that we did, closing back in last November. We had a target of 7% return for the first year, because it was a heavy, it was more of I don't want to say it's a heavy value add, because we're not doing heavy renovations, but it was definitely an operationally inefficient, and it was very far below market rents in terms of where the rates were. So that deal, we projected 7% year one. We're already on pace to north of 11% year one, and everything's looking good for the future of it. So we've been very happy with that, and I think that's really what we try to do, is set the bar at a place that we believe we can achieve or outperform, and that was just a crystal clear model of that being done. In terms of worst deal, I think there's a reason I sold my single family and my duplex. I think that those deals, I bought them at practically the market level, just because I saw them as long-term cash flow opportunities. But what I've realized is that for me, any investment that I make, I want to have not just cash flow, but I also want to have the opportunity to have it appreciate on the back end. So in that case, I realized that we're at the top of a long cycle right now, and I was going to have to hold those for the next 10 years if I was going to realize any true appreciation off them. So I think it makes sense as you're looking at any kind of investment, ask yourself, am I buying it at some level of a discount? Is there some way I can either, if you're buying residential house, make sure you're buying it either one that needs a lot of reposition so you can force appreciation, or buy at a time in the market cycle where you can create a lot of appreciation. If you're buying multifamily, it's really the same thing, finding out how you can create additional income streams or raise the rents to be able to create additional income or lower the expenses.
Yeah. Okay. So because I'm so glad that you cleared this out, and I guess there's going to be a lot of dislikes after your comment here, because people like, man, the duplex and the single family, it's the wealthy, the landlord is the who own the house and stuff like that. I mean, like even in the Europe, like, would you recommend for somebody to invest into buy a one single family home somewhere, let's say in Ireland, somewhere in maybe you're not familiar with Ireland, maybe somewhere in Dublin, and then some 300 kilometers away another place, and 300 kilometers in different place? Should you recommend for a person to do that, or just say, listen, just get focused, because investing into multifamily deals is available even if you're a different continent? Maybe you should focus on that and just get educated and learn about that and just prepare for that big move? Or would you recommend for them to invest in the small deals which you did before?
Yeah, it's all really comes down to a deal by deal basis, right? There's still phenomenal deals in any sector of real estate or any type of investing, that being said. So I think it comes down to the deals that you're looking at and what your standards are for your returns. If you're buying something that's already fully renovated and it has very low cash flow and not much opportunity for appreciation, then you should probably look elsewhere, right? But I think it all comes down to what the deals look like out there. And I'm not as familiar with the market in terms of how much cash flow you typically see out there. And I know in California, you buy a single family house and it's usually negative cash flow, right? So it's tough to make that work. So I think as long as you're finding some method of being able to see cash flow for today and have the ability to force appreciation on the back end, I think that's, for me, what I look for in most investments. But every investor profile is a bit different.
Yeah. The reason I'm asking you this, because there's a lot of people who are investing into houses, buying houses, and they don't have a clue what's going on in the market. I mean, the market is going to shift, anytime, and things will get ugly again, right? Am I right?
Mm-hmm.
So, but some people don't know about that, and they just have a regular jobs. Maybe they work in factory or doctors or somebody investing in doing those type of investments, and they think they're doing the right thing, but they don't know what's going to happen in the future because they think, oh, the real estate, man, everybody's is doing it, so I have to follow, And a lot of people still give the advice, because only multifamily can survive those type of downturns. Only those crises, only the right multifamily investments. You can also buy the wrong ones, right?
Yeah, absolutely.
But, the right investment can survive that. I mean, a single family home, I don't know, because, everybody's still saying, oh, go and flip, the flip, somebody's is saying, oh, go and flip, the wholesale, oh, invest into the house. Who should people start listening and making the right choices? Because a lot of people,
Yeah, no, it's a really good point. I think even, I have friends that do extremely well wholesaling and flipping houses. I just saw that being more of a transactional process. And I saw, the amount of volume that you have to do to produce, I saw it being just more than I desired, I guess, with my personal goals. So you can do really well in all aspects of real estate if you're a professional, but I think that's what it comes down to, right? That's why our slogan with our team is partner with professionals, right? Because, we live in the multifamily space. We have a vertically integrated business with 4 different companies that, eat, sleep, and breathe multifamily, right? So I think that, for us, this is something that we're focused on 24/7. So in an instance where you're maybe a doctor, right? And you might work 10-hour shifts, 5-6 days a week, but you can squeeze in 2 hours a week to focus on your real estate. Maybe it makes sense for you to partner with professionals on that, because if any of us ever ran into a challenge or we had to go visit a doctor, we're going to go see a professional to get, the best help possible. versus trying to figure it out. And I think real estate, treated right, treated as professional is, that's how you're going to see lasting returns and quality returns and things like that. So really, we always encourage everyone. We're all for people going out there and doing their own deals and being very successful. And we want them to do that, but we want them to treat it as professionals from day one. And I think that's the whole shift in mindset that I would always have is, like I said, not treating this like a shiny object or just kind of like an occasional hobby, but treating it like a professional. Even if you do have limited time to dedicate, make sure you're disciplined in dedicating that time and focused on dedicating that time, and make sure it's something you truly want to be involved with at a higher level in the long term.
Yeah, great point. Exactly. So thanks for answering my question, in that way. So can you just tell people about the importance again, having a team, and how do somebody should structure it? Because you mentioned, maybe somebody is working as a doctor and he's doing that full time, 14, 16 hours a day, and he doesn't have time to find the right deals and maybe invest into the right deals, because the multifamily is still available, right? Those deals are available, but maybe he doesn't have time. So leveraging like your money, maybe finding the partners and building a team to find those deals, and how people should structure it in the first place.
Well, that's exactly that, right? Maybe he has the net worth, maybe he has the money to go find the other guy that we spoke about, who's the guy that doesn't have the money, and he just has the burning desire, and he has the time to educate himself and go walk deals, right? So I think it's exactly that. It's just finding the people that can fill in the gaps to make a good partnership.
Yeah, exactly. So do you have what the contingency plan can person implement if the exit strategy fails? Any advice on that?
Well, I think you really want to evaluate how you're purchasing, right? Because your purchase should be in alignment with your exit strategy. And I think if you can secure fixed rate, longer term debt, which is usually our strategy, then you're able to provide yourself with optionality in terms of your exit. Because the last thing you want to do is be stuck in a position where you're a forced seller and the buyers have the upper hand on you. I think having long-term fixed rate debt and good cash flow gives you the chance to really evaluate when the opportune time to sell is. And if it doesn't work out at that time, you have the option to sell at another time.
Yeah, okay. So that's based for multifamily market specifically. What about the housing market, about the single family?
Well, I think same thing there. And if you're buying single family rentals, just make sure you have cash flow, right? I think cash flow is your savior in single family or multifamily, because in tough times where rents are lower or occupancy is lower, then you want to have cash flow to get through the tough times. And that is the challenge with single family.
Yeah.
If someone
what
moves out,
if the cash flow is negative? I mean, I'm losing more money than I'm making. What about that?
I wouldn't buy it.
So again, that's the point, guys. If you don't follow, if you don't take Dylan's advice, and get obsessed, first of all, knowing this is the space I want to be in. Don't dabble I'm going to be this, I'm going to be a marketer, I will be a professional at my job in sales, and I will do real estate. And how many things are you doing? You just real estate, right?
Yep.
So that's what you guys, if you want to be successful at this, follow Dylan, go and check it out, his company and what they do, what type of investments they do, and just follow his advice, because a lot of people would get hurt in the next cycle, I think, because they've just following a wrong advice, and again, what's going to be the option for them, if they're losing money on a house, well, I'm going to sell, I'm going to give it away, what's the option? So
yeah,
I don't
exactly.
know. I don't know. It's going to be tough, but it's for those people to figure this out, right?
Well, that's why you have shows like yours in place, right? And that's the whole goal, right? Spread the right message and educate the group. So I think it's a great thing that you're doing here.
Exactly, because it doesn't make sense. How many times, guys? Because there's a lot of people still thinking about buying a house, buying a duplex, and look how many people in the space. People who are investing, having thousands of units, they don't talk about house, buy a duplex or they're talking about the huge properties, right? because that's where the money is. That's where the wealth is. You know, even the guys. I remember watched this video of the guy. He used to own like 500. No, I'm sorry. That was a Dean. Do you know Dean Graziosi? Yeah.
Yeah.
He used to, like, he owned 1,500 something houses or something like that. So he said, I will sell them all at the end of the year, you know, until this end of the year, because he said, I want to go big into like multifamily. Even those guys, you know, they don't talk about like they are selling when you are buying. Yep. So, guys, you know, like, who do you follow, guys, for advice? You know, this show is not sparkling. I don't have any fancy, you know, schmancy like going through the screen, but this is the truth that people need to hear. You know, that you need to invest into multi-family units. So what do you look specifically when touring the properties? There are specific things, you know, you underwrite a deal and, you know, it looks good on the paper, but you want to go and visit and do the due diligence over there. What do you look for?
Yeah, I would say you want to look for the big expense items that might you want to budget in. Say, see what the roofs look like. First, see what type of roofs they are. We usually prefer pitched roofs because they usually last a little bit longer. You can see what the materials, the roofs and the siding are made out of. But you know, you want to see what age the roofs were, what age the roofs are when they were last replaced. Same thing goes for HVAC.
And it's 20 for roof. It's 25 years.
Usually 10 years, 25 would be a really long time ago. Yeah.
Okay. So if the property was built 1990s or maybe 2000 or maybe in 2000s, like, and you have 5-year exit strategy, and how is that going to affect the whole thing?
Well, usually they should have been replaced at some point, but if they haven't been yet, then yeah, maybe you want to consider. It all depends on the condition, right? If maybe you're in California and it doesn't rain a whole lot there, maybe it's in better condition than if you're in the Northeast where you're getting rain and snow every year, right? So I think just taking a look at what the condition is, but you want to just budget in for what could go wrong, right? Because there's a lot of things that could go wrong, especially when you have old roofs and old HVAC and you know, maybe leaky pipes, things that can cost you a lot of money over time. So I think that's really what we're looking for. And then in addition to that, you're looking at, you know, the property itself. You're getting a good feel for the type of people that live there, who the residents are that you're catering towards. Getting a good feel for what the unit mix is. Getting a good feel for the walkability of the area. What are the local stores in the area? Where do most people here work? What does the parking lot look like? What kind of condition is it in? Is there enough parking for the residents? What are the amenities? Are there washer dryer hookups? We find that's the number one, most demanded amenity across the board, and least supplied. So you want to just take a look, you know, across the board at the overall fundamentals on the property.
Okay. So, and if it matches the underwriting, I mean, you know, like, how many properties did you, like, you checked, you did the due diligence on paper, and then you went and checked the property and it was the opposite? Like,
it happens pretty often, right? And that's the challenge if you're investing from out of state or out of country, right? If you're not actually taking trips to the market, then that's what you wind up with, right? Is you wind up with this deal that looks like you found the magic golden egg, right? But then you go out and you visit it, and you find out that you're in a rougher part of town, and it's just not something you want to be near, right? Now, of course, you can also find this stuff out by looking at the income in the zip code, or I look at the census tract, or you can look at the crime rates. There are other triggers out there, but you know, there's of course a lot of the worst deals out there look like the best deals on paper if you're just purely looking at it from a numbers standpoint.
Okay, yeah, got it. So basically, how many times, like, do people lie a lot in the real estate space? Like, if I'm gonna go and the owner is gonna be like, oh, listen, we just changed these roofs like half a year ago, and then you see it's painted, and then it says it's a copper wiring, and then it's like iron. Like,
I think in our space, I think it happens a little bit less, because a lot of times we're looking at deals that are 200 plus units, and usually you're dealing with more institutional buyers that value their reputation and things like that, right? You still have the mom and pop owners as well, and there are mistakes people make, but I think we don't run into a lot of people directly lying, but sometimes they'll try to just kind of slip stuff under the rug, right? It won't be a direct lie, but it will be something that they just forgot to tell us about, right? And then of course that's why we do a very thorough inspection. That's why we walk every single unit. We bring a team on site, because it's not what they tell you that's wrong. It's usually what they're not telling you.
Yeah, exactly. And how do you find that? I mean, do you have your own team in place who does the due diligence process?
Yeah, we have a whole team that we bring on to any property. We walk every single unit, take pictures. We'll run cameras down all the pipes. We really look at the whole property inside and out.
Yeah, well, like I read a few books myself about like syndication and stuff. Like, and people who are watching right now may be thinking, man, like, because like I know and you guys who are watching right now probably know that there's a lot of things involved into like doing the syndication deals, and like we can talk about this like hours and hours. But like, do you have a book for somebody to recommend? Let's say somebody wants to start like investing, or maybe get to know into real estate space more about that. For
depends on what you want to do. I have a lot of books. Eventually a lot of your learning comes from doing, but I think starting off, if you're looking at the legality of syndication, how to protect yourself if you're doing a deal, or you just want to learn how the overall process works, I think Gene Trowbridge's book called "It's a Whole New Business" is a great one. It's written by a syndication attorney. We actually work with his old partner, Kim Taylor. She's our syndication attorney in every single deal. But the book "It's a Whole New World" by Gene Trowbridge, is a really good one at kind of explaining the ins and the outs of how the 506B and the 506C structures work, and what to do to protect yourself, and at what point you should make it a formal syndication when you're doing a deal. I always got to recommend by Jake and Gino. It's Jake Senziano and Gino Barbaro. There's Wheelbarrow Profits, and that's the first book on multifamily that I picked up, and I think they outline it in our 3-step strategy that we use to this day, which is buy right, finance right, manage right. Right, and it walks through how to develop your own parameters that are going to assist you in going out there and finding your own deal, or how to look at deals that you're considering investing into with a deal sponsor. So yeah, I think that those two are good ones.
Yeah, love it. And I love especially what you said in the first place. It was like, I asked you, what's the book? And you said, it's not a book. You need to walk the property. Like you need to, like, because again, that's why I asked the question, because like not everybody, I'll take that back, guys. Some people are looking like, what's the next book? What's the next answer? Like the answer is not in a book. It's like into walking the properties, like building the team, like this is the hard stuff that people need to do, but nobody wants, everybody is looking for this, like quick answer. What's the book? What's the training course? What's the, like, guys, like it's simple. Like go and walk the properties first, like build a team as Dylan said, and
you gotta get the book knowledge at one point. You have to go and dive into all the books, learn all the language. Otherwise, no one's gonna take you seriously if you don't know what you're talking about. So you have to get all the book knowledge at first, but after reading, a good handful of books and taking a lot of the online courses, for me, I've taken a ton of online courses. I've taken CCIM, read every book I can get my hand on in the first 12 months of studying this stuff. So you have to go through that phase, but after a certain point, you're really going to have a lot of the basics down, and then it comes down to action. Right? Exactly.
But because it can become an analysis paralysis, like I know a lot of people that are stuck in this educational process. They just study and look for, an exit, which is, there is no exit over there. So what you mentioned, some real estate technology that you use while investing. Is there a specific like technology that helps you while investing? You mentioned one before. I can't remember the name.
I mean, we use Excel just for all of our underwriting stuff for the most part. We use a lot of different online sites to source data. Most of it's free stuff. I don't think you need any of the paid data services in the beginning, or even now where we are. I think there's a lot of brokerages that will release data on the markets. There's a lot of websites that can track the different counties and the median income and things like that. So if you really search around, there's a ton of resources out there that'll help you with data, even stuff like rent comps and things like that.
Would you recommend like for people to go and start investing into some, like let's say the multifamily calculators, like how to calculate the deal and maybe buying a RCM and all these things. Is it worth it for people at the beginning, or do they just?
I mean, I don't know how else you're going to underwrite a deal in the beginning, right? Unless you're, I guess, unless you get one for free or you go out and make one yourself if you're proficient with Excel and you really understand how the deals work. But I think, I mean, I spent a lot of money on learning it, at first. Like I said, it's not something that's going to be an ongoing thing, but in the first 6 to 12 months, I think it makes a lot of sense. Same thing there, right? If you're trying to save money on spending a little bit of money on getting educated, then I think it's probably the wrong business for you, right? Because this business has so much potential, and I would be focused more on how do I do everything I can to learn as much as possible to be the best possible, because one mistake in this business can cost you a ton of money, and the time that it's going to take for you to figure all this stuff out, and the mistakes can be really costly.
Exactly. Great ending. Love this. So can you just remind people how they can invest with you, and what returns should investors expect from your end?
Yeah, happy to. So in terms of investing with us, best way to do it is start a conversation with us. If you visit Rand, R-A-N-D, Partners LLC.com. That's Rand Partners LLC.com. Yeah. On there,
you're gonna find register down below, guys.
Cool. You can register for our investor portal there. You can plug in to see either deals that we have now, or I'll also add you to. You'll receive an email from me right away where we'll have the chance to set up a call. So schedule a 15-minute call with me. We'll discuss kind of your goals, and I'll help out any way I can. And then we'll have you plugged in to view the upcoming deals as they come. We usually announce those only to the investors we've already spoken to on the phone and built some kind of relationship with. And at that point, we'll send you deal updates, so we can always plug in there. And then just like I think you and I had initially started talking on Instagram, it's at Dylan, D-Y-L-A-N, Marma, M-A-R-M-A. If you guys want to reach out there or ask any questions, feel free.
Awesome. Love that. You're a great guy, so I really appreciate for doing this. And I mean, like the company that you built, like how long did you start it in the company?
Well, so like I said, this company started by the two of our founders, Jake and Gina, started it back in 2013. So I've really came on board beginning of last year, more so to help grow the syndication division, where we started to open up the doors to outside investors. Because for a while it was just purely in-house capital. So now I play a lot of a large role in terms of investor relations and acquisitions and kind of developing systems so that we can begin to scale and also have investors partner with us on different types of deals.
Yeah. And you're planning to acquire, like, what's the goal for you guys until the end of this year? How many units more you think you're going to acquire?
I mean, it really comes down to what the market hands us. I think doing 3 to 4 deals this year would be great. I think we're closing on our first one now, so probably a few more deals this year. I think setting a goal and trying to achieve the goal just for the sake of achieving it in this space is not, it's kind of counterintuitive, right? You have to really just be persistently taking action, looking at a lot of deals, and then I think waiting, because you have to be patient and persistent for the right deals to come up. So I think, but realistically, I think 1 deal a quarter is probably pretty achievable.
Yeah. Okay, got it. So guys, please again go and check out Dylan's link with the Rand Partners. Go and check it out, the website. Get in contact with this man. Like even if you're watching this video, like in Ireland, please let me know in the comments. We can keep.
Well, it's funny because you're in Ireland, and we were talking before the call. I'm actually 50% Lithuanian and 50% Irish, pretty much. So it's pretty funny. We had that connection starting off.
That's awesome, man. I love it. The coincidences, right? So guys, everything is available. Like people can still invest with you if they're in Dublin or in Lithuania or in Russia or in China. It doesn't matter for you, right?
Yeah. Yep. There's some nuances to it, but we can definitely talk about it if it's something that you're interested in, and I'm sure we can make it work.
Yeah, of course, because the real estate, especially the multifamily space, is the right space to be in. So Dylan, again, thanks. I appreciate for your time and for everything, for the information, the value that you put out for the people, man. It's just crazy. So please, again, like and subscribe to the channel, guys. And I really appreciate you watching. I appreciate Dylan for being here. So I'll see you until the next time.